One of my favorite ways to find investing ideas, stealing from super investors. Super investors are investors with over 100 million in assets under management, and every quarter they are required by law to reveal all of the moves they've been making in their portfolio. And I recently compiled the data to make a list of the top 50 most frequently bought dividend stocks by super investors in the most recent quarter, and you can actually download this sheet for free in the description. So in this video, we're going to be reviewing the top 10 most bought dividend stocks by super investors, so let's go ahead and dig in. Now, as I was analyzing the most frequently purchased dividend stocks by super investors, I garnered some key stats together and I found a couple of key takeaways. Now, one of the things we already know to be true about super investors is they have a clear bias towards high quality stocks. How do we know this? Well, we can see they buy stocks with low payout ratios, high levels of dividend growth, and on average, higher levels of return on invested capital, meaning these are companies that can generate very profitable returns when they reinvest back into the business. But here's what I thought was even more interesting specifically about this most recent quarter. Keep in mind, all the purchases we're looking at are from Q4 of 2024. I'll explain why that's interesting here in a second. Now, typically, the most frequently purchased sectors we see are going to be technology and it's going to be financial services. Think about Warren Buffett and Charlie Munger. They loved their financial services stocks, and the same is true for many other super investors. But here's what I thought was interesting. Healthcare was the second most frequently bought sector. Now, let's take a step back here for just a moment. If we look at the S&P 500 year to date in 2025, right now it's down by about 4%. But if we jump over and look at Vanguard's Healthcare Index Fund, what we can see is year to date, it's up by about 5.27%. So we're talking about a pretty significant outperformance in just a few month time period. Now, one of the things we have to understand about healthcare stocks is they typically outperform in bearish markets. At least that's what history has told us. And JP Morgan actually recently put out a pretty interesting chart. And what this is charting out is the S&P 500 PE ratio over the last few years versus healthcare stocks within the S&P 500. And what we can see is in early January of 25, the difference in valuation got pretty significant. The healthcare stocks were trading about 17 times earnings while the S&P 500 was about 21.2 times. And again, like I already pointed out, since then, the S&P 500 down around 4%, Vanguard's Healthcare Index Fund up about 5.27%. And this is one of the many reasons I think it's so interesting to pay close attention to insiders and what's going on, and not just look at each individual insider, but actually compile the data and see what the trends are. I think one of the clear trends is they were a little bit more defensive in this most recent quarter, and as of right now, it's paying off. So to start off, let's look at the top 5 of these stocks that were bought by dividend investors. We can see we have at number 10, Bank of America, number 9, Google, number 8, we have LPL Financial Holdings, another financial stock, we have Starbucks, and then we have UnitedHealth Group Incorporated. Now, this is obviously interesting for many reasons, but I want to pay close attention to UNH, Starbucks, and Google, and let me show you why. I track every single quarter what these super investors are buying. And in fact, if we look at the quarter before this most recent quarter, Q3 of 2024, here's what we can see. Starbucks was on the list. Google was on the list. And then if we go back even further to Q2 of 2024, here's what we can see. UNH was on the list at number 1. We can see Starbucks was on the list. We can see Google was on the list. I share all this information over on Dividendology.com, link in the description. So specifically, when we talk about Starbucks, Google, and UnitedHealth Group, it's important to note that this wasn't the first quarter that super investors have been buying these 3 stocks. They've basically been loading up on these stocks for the past year now. And in my opinion, this is one of the many reasons that we don't want to just look at individual super investors and what they're buying and selling, but if we can conglomerate the data, we can get some pretty interesting takeaways like that. Now let's take a moment to take a closer look at Google stock. If we look at Google over the past year, yes, they're up about 9.56%, but look at them year to date, now down by about 12.69%. Look at them in the last month, down almost 11%. And so if we go ahead and jump over to my stock screener, let's come up here and plug in Google. All this data will load in, and of course, like always, if you'd like to download any of these spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, when we look at Google, we quickly get the signs of a quality stock. Revenue per share has grown tremendously over the past decade. The same is true with earnings and, of course, free cash flow per share. If we look at return on invested capital, we can see it's been above 20% for 4 consecutive years. Again, that's a sign of a high-quality company. The company virtually has no debt compared to their total assets, and then they did announce last year that they're going to start paying out a dividend. Obviously, right now it's very small with a yield of about 0.5%, but the payout ratio is only about 7.35%. Now, I'm seeing a lot of talk online about how Google is undervalued right now, so let's assess that statement. To start off, let's go ahead and jump over to my stock screener and come up here and plug in Google. Now, the first thing that I want to look at how Google has historically been valued. So we're using a price to earnings ratio valuation and looking at it over the past decade. And what we can see on average over the last decade, the PE ratio is about 29.24. Now, if you look closely, obviously there's a huge outlier here in 2017. So what if we remove this? Well, the average PE ratio over the last decade drops down to about 26.09. Well, for the trailing 12 months, it's about 20.02. So Google looks about 23% cheaper compared to how it's historically traded. But here's where things get even more interesting. Look at the forward-looking price to earnings ratio here on Seeking Alpha, just 18.12. Now, a company getting a lower price to earnings ratio can sometimes be warranted if the future earnings potential of the company has decreased. But let's look and see if that's the case for Google. If we look at earnings estimates, we can actually see they're quite good. We're talking about 12%, 14%, 16 or 17% growth projected on the upper end. So earnings are still projected to grow at a pretty high rate for this company. If we jump back over to the stock screener, let's look at the discounted cash flow analysis. How fast do we expect the future free cash flows of the company to grow? And keep in mind, earnings growth and free cash flow growth are typically going to be pretty close to being similar. And for example, if we jump over to my free cash flow analysis sheet, I've already plugged in Google. But if we zoom in, we can see the company translates a lot of their earnings into free cash flow, especially over the last few years. So again, if earnings are growing, we can expect free cash flow to grow. So let's go with the low end of that growth rate projection of about 11.5%. What we can see based off that projection is we'd come to a DCF price per share of about $181.13, which is around 9% higher than that current share price. If we bump this up closer to about 13%, which I think is very realistic, we come to an intrinsic value of about $201 per share, close to 21% higher than that current share price. So in my opinion, Google certainly looks like an opportunity, and super investors tend to agree. Now let's take a moment to talk about Starbucks stock and what a ride this company has been on over the last few years. In the last year, yes, they're up about 8.3%, but that definitely doesn't tell the whole story. If we zoom out and look at the past 5 years, at one point they were trading as high as about $126 per share in summer of 2021, and they've never recovered to that price. And if we look at the last year, you can see there was a huge sell-off last year in April after they released a horrendous earnings report where they basically stated that sales were down, foot traffic was down. Yes, their average ticket price was up a little bit, but not enough to make the earnings report look any better. So the stock saw a huge sell-off, going from $88 all the way down to about $72.50. And here's where they fired their CEO and brought on the Chipotle CEO, Brian Niccol, and ever since then, sentiment around this stock has been quite a bit better. But don't get me wrong, this is still certainly a turnaround play. If we look at this stock in the last month, it sold off just like the rest of the market, down about 12.1%. Now, part of the good news is historically, this has been a pretty good dividend growth stock. Come up here and plug in SBucks on my dividend breakdown sheet. What we can see with Starbucks is the starting dividend yield is sitting at about 2.38%. And historically speaking, over the last decade, dividend growth has been quite good at about 13.25%. Been a little bit slower over the last few years, though, at about 7%. Now, one thing we do have to make note of, though, is the free cash flow payout ratio based on the trailing 12 months is about 78%. They're using a lot of their free cash flow to pay out dividends. I'd say that's probably quite a bit higher than I'd want to see it for a company like Starbucks. To put this into perspective, if we look at what it was earlier in the past decade, 2015, around 38%. If we look in 2016, again, 37.5%. In 2017, 54.63%. So we don't like the trend of the free cash flow payout ratio going up. Not a good sign. If we jump over to our stock screener and come up here and plug in Starbucks, what we can see is, yes, top lines have been growing, but earnings, especially since 2021, have been a little bit choppy. The same is true with free cash flow per share. Yes, they have been reducing their shares outstanding, and we can see return on invested capital has actually been pretty decent. But one of the things I don't like is if we jump over to the profitability sheet, look at this. We're seeing a decrease in the gross profit ratio. Starbucks has been increasing their prices, but this has been met with less consumer demand. As a result, we see lower gross profit ratio. The 10-year average was about 28.3 and last year's about 26.8. Unfortunately, I think this is a company that is somewhat sensitive to economic conditions. And to be perfectly clear, there's a lot of competition in the coffee market. So in my opinion, this is a situation that's a little bit unique. This is certainly a turnaround play by all means. And turnaround plays can be pretty difficult to judge. They can be pretty difficult to value. Really, what it boils down to is how effective will the current management team be? There's a lot of confidence in Brian Niccol, the former Chipotle CEO, and we can see why just by looking at Chipotle's stock price. If you look at them over the past decade, they're up about 260%, but it was much higher before Brian Niccol left, which was somewhere around right here. And now let's take a moment to talk about UNH, UnitedHealth Group Incorporated, in the healthcare sector. And this is a stock that has been under a lot of scrutiny lately. Over the past year, they're only up about 2%. If we look at them year to date, it's actually traded relatively flat, outperformed the S&P 500, and if we look at the last month, it's actually up close to about 1%, again outperforming the S&P 500. And this is a stock that's really grown its dividend at a high rate over the past decade. What we can see right now is the starting dividend yield is sitting at 1.67%, but they've really been ramping up the growing dividend. 10-year dividend CAGR, 16%, the 5-year, 11.7%, and the payout ratios have looked quite healthy for the entirety of the past decade. Just look at this dividend growth chart. It really is beautiful, and of course, it's backed by growing free cash flow. Now, what we can see in 2024, for the first time in pretty much the past decade, there was a somewhat decent decline in free cash flow. And in fact, if we jump over to the stock screener, come up here and plug in UNH, what we can see is the same was actually true with earnings. Earnings were growing at a pretty high rate, very stable and very predictable until 2024. So what happened? Well, if you don't recall the news, UNH had a cyber attack in 2024, and this proved to be pretty costly for the company, but the majority of this came out to be a one-time cost, so earnings should recover. Now, this is important to remember from a valuation perspective, and let me show you why. If we jump over to our stock screener, come up here and plug in UNH. Look at the historical multiple valuation. What we're going to do is we're going to go ahead and zoom in. Then, of course, with ticker data, let's go ahead and fill this data in from where we removed it for Google, and what we can see is the average PE ratio for UNH over the last 10 years is 21.35, but in the trailing 12 months, it's actually significantly higher, 51% higher. Why is this? Well, again, it's because we saw the drop-off in earnings in 2024, but we have to remember this was a one-time cost due to the cybersecurity attack. So how do we mitigate this? Well, let's take a look at the forward-looking price-to-earnings ratio. If we look at it on Seeking Alpha, it's sitting at just 16.93. Let's compare that to how the stock has historically traded. If we come up here and plug in 16.93, all of a sudden we can see the forward-looking price-to-earnings ratio is 21% lower than the average PE ratio over the last decade. This is why it's so important to understand what's actually going on with this stock, and to understand if the issues they're facing are short-term issues versus long-term issues. If we take a look at this stock from a free cash flow analysis, assuming just 11% free cash flow growth, again, I think this is very attainable for the company, the intrinsic value comes out to about $601 per share, which is about 20% higher than that current share price. And then if we jump over to our dividend discount model, we're valuing this stock based on how much to pay out in dividends and how much that dividend is increasing. And assuming a 7% dividend growth rate, which like we saw earlier, seems to be quite achievable for the company for a very long time, we come to an intrinsic value of almost $600 per share, 19% higher than the current share price. So yes, this is definitely a stock that doesn't have a lot of positive sentiment around it at the moment, and it's certainly under public scrutiny. But unless we get some major healthcare reform, this stock certainly looks undervalued. And like I mentioned earlier, they're not just taking advantage of it in this most recent quarter, they've been taking advantage of it for a while now because it was the most bought stock by super investors in Q2 of 2024. Now, coming in at number 5 on our list, we have Taiwan Semiconductor Manufacturing, stock ticker TSM. And if we look at the stock over the last year, it's done really well, but it's certainly seen a bit of a sell-off year to date. Look at them year to date, down about 12%. Now, look at the rating summary here on Seeking Alpha. Analyst, strong buy. Wall Street, quant, strong buys. People are quite bullish on this stock right now. So let's go ahead and look at them from a dividend breakdown perspective. Come up here and plug in TSM. And what we can see is that starting dividend yield is sitting at about 1.34%, and there's been a little bit of fluctuation with the dividend payments throughout the past decade. And it is worth noting, I believe prior to 2019, they just paid out one annual dividend, and then after that, they started making quarterly dividend payouts. But what we can see is they're not using a lot of their free cash flow to pay out dividends, only about 41%, But perhaps what's even more impressive is look at the free cash flow over the past decade. Yes, we're trending upward, but then boom, in 2024, it exploded all the way up to $870 billion. And that's just the reality of the industry that they're operating in. If you're not familiar with Taiwan Semiconductor manufacturing, this is one of the leading global semiconductor companies headquartered in Taiwan. And one of the most important things you have to understand about this company is who their customers are. They have customers like Apple, Nvidia, and Qualcomm, which means this company has a pivotal role in the global semiconductor supply chain. And while there is some geographic risk due to the fact that a lot of the company is located in Taiwan, they currently have additional facilities planned in the United States, Japan, and Europe, which will also help meet demand. Now, when it comes to TSM and valuation, we have to understand, yes, they're in a sector, they're in an industry that's growing at a high rate. And if we look at earnings estimates from analysts over the next few years, we're talking about almost 29% earnings growth projected over the next year, the following year, close to around 18%. But despite this, we can see the forward PE ratio for this company sitting at just 19.09. I'm not surprised to see this company on the list of super investor buys. Based on future earnings potential, the stock does appear that it might be slightly undervalued. With that being said, I think you could potentially see a lot of volatility specifically in this sector and in this industry. Coming in at number 4 is probably the stock that will surprise most people, and that's CVS Health Corporation in the healthcare sector. And if we look at this stock, it's down about 13% over the last year, but that doesn't really paint the whole picture. If we look at the last 5 years, we could see in February of 22, the stock was trading at about $104.24 per share, significantly higher than the current share price. But take a look at what's happened just in the last few months. Let's go ahead and take a closer zoom in. We can see in mid-December, the stock was trading at about $45.28 per share, compared to now $67.91. Again, keep in mind, we're looking at the super investor moves in Q4 of 2024. That's the most recent data we have. So a lot of super investors have already made a lot of money on this stock. Year to date, it's already up 51.28%. And if we look at the stock from a dividend perspective, come up here and plug in CVS, what we can see is the starting dividend yield sitting at about 3.92%. So this is one of the higher yielders that we're going to see on this list. And the free cash flow payout ratio is sitting at about 53%. So using around half their free cash flow to pay out dividends. But look at the trend in the free cash flow payout ratio over time. In 2021, it was just 16 to 17%, and it's been climbing at a high rate. Why is that? Well, free cash flow has been declining while the amount paid out in dividends every single year has been increasing. So no wonder that free cash flow payout ratio has climbed at such a high rate. We jump over to the stock screener and plug in CVS. When we look at some of these stats for CVS, we don't necessarily see the signs of a super high quality company. Yes, top lines, revenue per share has been growing, but earnings per share has been pretty stagnant and even declined in 2024. And like we already pointed out with free cash flow on a per share basis went from $11.94 in 2021 all the way down to $5.02 in 2024, less than half of what it was just a few years ago. If we look at return on invested capital, it's actually been pretty bad for about 5 or 6 years now. If we jump over to our profitability and income statement sheet, we can see the gross profit ratio for this company is actually declining. So yes, revenue's growing, but the cost of revenue is growing at a higher rate. There's a lot of things that you can see with this company that actually frighten me quite a bit. So again, I think we're looking at a turnaround play here. Turnaround plays can be difficult to invest into because it's definitely either feast or famine. But even with free cash flow declining pretty significantly in the last few years, we can see the company has a free cash flow yield of about 7.39%. So for every $100 you invested into the company, they generate about $7.39 in free cash flow. Now, ideally, your free cash flow yield would increase over time as the company grows their free cash flow, but unfortunately for CVS, their free cash flow has been declining. Coming in at number 3, we have Equifax in the industrial sector, stock ticker EFX. And if we look at the stock over the last year, it's down about 6.77%, so underperforming the market. And if we look at them year to date, down close to 5%, which is pretty close to that of the market. And if we look at the last 5 years, yes, they're up about 109%, but if you would have bought at the top in 2021, it was trading at about $294 per share. You'd still be down a pretty solid bit on your initial investment. Now, if we look at this stock from a dividend perspective, jump over to the dividend breakdown sheet. Now, there's 2 things, actually probably 3 we can tell about this company pretty quickly. Low starting dividend yield, but the dividend policy has not changed for this company for a long time. And it's easy to see why. Look how unpredictable the free cash flow has been, especially since 2018. I mean, it's been bouncing all over the place. And typically, dividend growth is a sign that a company or a management team is confident that they'll continue to grow free cash flow in the future. But if it's going to be this choppy, I can understand why they wouldn't want to grow their dividend. If we go ahead and jump over to our stock screener, let's take a closer look. What we can see is revenue per share from 2014 sitting about $20.10 and bumped up to $45.89 in 2024. So top lines have been growing without really buying back a lot of stock. So most of that is going to be organic revenue growth. Now earnings really haven't gone anywhere, especially since 2021. And again, keep in mind, $6.11 in 2021, and that's when the stock was trading at its peak, which really makes sense in reality, but since then, the earnings have declined. So what does the future earnings potential of the business actually look like? What are analysts saying? Well, let's go ahead and take a glance. What we can see is we're projecting low earnings growth over the next year, but pretty rapid earnings growth in 26, in 27, in 2028. That's impressive, but we do have to keep in mind, look at the forward-looking price to earnings ratio. It's quite high, sitting at about 31.12. So really to justify that high price to earnings ratio, they do need to be growing earnings at a pretty high rate. If we look at this company from a historical price to earnings ratio valuation, let's go ahead and remove our outlier in 2019, and we could see the average PE ratio over the last 10 years is about 36.75, so it's very, very high. Now for the trailing 12 months, yes, it's sitting at 49.73, but again, look at that forward price to earnings ratio, about 31.12, so we do have to make note of that. If you look at it based on the forward price to earnings ratio, the company actually looks a little bit undervalued compared to its historical valuation, but for me, this personally isn't a stock that's on my watch list. I don't want to buy a stock that has very choppy free cash flow. I want to make my investing as simple as possible. I want to buy companies that have very predictable, very reliable growing free cash flow that can in turn grow their dividends very reliably as well. And then coming in at number 2, we have Ferguson in the industrial sector. So now we have 2 industrial stocks in a row. And if we look at this stock over the last year, it's down significantly. It sold off about 23.34%. And again, super investors were buying this during Q4, and I hope they liked it at that prices because it's at even lower prices now. So let's take a closer look at the stock from a dividend perspective. Again, this is another stock that's dividend payouts have fluctuated quite a bit over the past decade, but the starting dividend yield as of right now is sitting at about 1.46%. Now, the dividend hasn't grown at a high rate, but the free cash flow has. We can see in 2014, free cash flow was about $424 million. In 2023, it got as high as about $2.28 billion, and 2024 finished at about $1.5 billion. So what we can see is, yes, there is quite a bit of fluctuations in the free cash flow for this company. But what do future free cash flows look like? Well, let's go ahead and look at some earnings estimates for the company. What we can see, earnings are expected to decline in 2025, probably part of the reason we've seen the sell-off, but after that, we're talking about 13 to 14% earnings growth. Let's go ahead and jump over to our free cash flow analysis sheet and come up here and plug in the stock ticker. One of the things we have to understand with a lot of industrial stocks, a lot of energy stocks, is the free cash flow conversion can fluctuate a lot. In fact, take a look at the free cash flow margin. Let's talk about free cash flow margin for a moment. This is telling us out of every $100 in revenue the company generates, how much actually becomes free cash flow. And we can see in 2014, it was as low as 1.91%, and in 2024, it was 5.06%. So if we look at just the past 5 to 6 years, it's actually significantly better than it was in the past decade. But yes, it can still fluctuate quite a bit on a year-over-year basis. Now, if we look at the valuation metrics, the free cash flow yield is sitting at about 4.15%, which compared to most stocks, maybe in the S&P 500, that's a pretty decent free cash flow yield, but it is a little bit below their 10-year average. Let's go ahead and jump over to my stock valuation sheet and look at our discounted cash flow analysis. Now, assuming a free cash flow growth rate of 9%, starting with 2024 free cash flow, we can see we'd come to an intrinsic value of about $165.15, which is very close to the current share price for this company. And then coming in at number 1, the most bought dividend stock by super investors in the most recent quarter was Microsoft. And this is one of the largest positions in my personal portfolio, and super investors have been buying this like crazy over the last year. Look at this. In Q3 of 2024, again, this was the number 1 most frequently bought dividend stock by super investors. If we look at Q2, it was the second most bought dividend stock by super investors. So being on this list is certainly nothing new for Microsoft. Now, if we look at them in the last year, they're down about 8.1%, and they even hit a high at one point in July of 24 of about $468 per share. If we look at them year to date, like most tech stocks, down by a bit, down 8%. But if we go ahead and look at them from a dividend perspective, we'll come over here and plug in MSFT. And what we can see is the starting yield, yes, it's low at 0.81%, but this is certainly a good dividend stock, and I'll show you a few of the reasons why. Now, to start off, yes, dividend growth has been very good, close to about 10% over the past decade, and the dividends have been growing very reliably, very predictably. And the reason they can do that is because, yes, the free cash flow payout ratio is low, less than 30%, and it's also trending downward over time. We'll make note of that here in just a second. But look at how steady and how predictable and how fast the free cash flow has been growing over the past decade. In the last 5 years, they have a free cash flow CAGR of over 14%. Now, because they're growing free cash flow at a rate faster than they're growing their dividend, their free cash flow payout ratio is actually decreasing over time, meaning they're having to use less and less of their free cash flow to actually pay out dividends, which actually means if they chose to do so, they could grow dividends at a much higher rate. But the time to do that is not quite yet. Let me show you why. If we jump over to their most recent earnings report, we have to keep in mind, yes, there are 3 business segments, all are seeing pretty decent growth, but take a closer look on the 6th slide. What we want to pay attention to is the cash flow. Free cash flow was $6.5 billion in the most recent quarter, which was actually down 29% year over year. Why is this? Well, this is reflecting higher capital expenditures to support our cloud and AI offerings. So free cash flow's down, but this was to be expected. This is for the future benefit of the company. It's really important we understand this. Now, something else we have to understand about Microsoft is it's basically its very own tech ETF. Look at all the different products. Look at all the different business segments that Microsoft is currently offering. And look at the growth we're seeing from many of these products. Commercial bookings up 67%, commercial remaining performance obligation 34%, Microsoft Cloud revenue 21%, Microsoft 365, all these different products are pretty much seeing double-digit growth. LinkedIn revenue is up about 9%. Come down even further, we can see server products and cloud services up 21%. Basically what I'm trying to say is this is a well-diversified ETF all in one company, and most of their products are seeing very high levels of growth. Microsoft has been one of the largest companies in the world for decades, and this is a large part of the reason why. If we go ahead and jump over to our stock screener, let's come up here and plug in MSFT. What we can see is revenue per share has grown at a really high rate. The same is true with earnings, free cash flow per share, and look at the return on invested capital. It's been really good, especially since 2019, for the most part, above 20%, a sign of a high quality company. And look at this, the debt to assets ratio has been going down, indicating balance sheet health. If we jump over to our profitability sheet and plug in Microsoft, what we can see is not only does the company have a very high gross profit ratio at 69.8%, but that's above the 10-year average. Again, a sign of a competitive advantage. So what about the valuation? Super investors obviously love this stock, and it's one of the largest positions in my portfolio, but has it become more attractive at $387.82? If we go and jump over to the stock valuation sheet, I've plugged in Microsoft. Start by looking at the DCF valuation. Go ahead and zoom in. Assuming 15% free cash flow growth for the stock, it's worth about $345.31 per share. If we look at the historical multiples valuation, what we can see is it's a little bit more expensive compared to how it's historically traded, about 7.8%. But keep in mind that forward price to earnings ratio is sitting at about 29.09, which is quite a bit closer to that historic average. Now, if we compare Microsoft to some of the other big tech stocks, we can see the average PE ratio for stocks like Apple, Meta, Amazon, sitting at about 30.23. And if we applied that same average PE to Microsoft, we'd come to an intrinsic value of about $377.01 per share. Finally, if we look at them from a dividend discount model perspective, how much are they paying out in dividends and how is that dividend growing? Assuming an 8.25% dividend growth rate, we'd come to an intrinsic value of about $456.09, which is really about 17% higher than the current share price. So if we jump over to that output tab and average the 3 valuation models here that we used, we'd come to an intrinsic value of about $392 per share, which is very close to the current share price. It's only a little over 1% off. So technically with a 10% margin of safety, the acceptable buy price would be about $353. But here's what you should understand, and here's what super investors understand. You have to pay a premium for the highest quality companies. These are companies that are generating high returns on invested capital, meaning the projects they reinvest their capital back into get very high returns. Yes, a PE ratio of 29.09 seems expensive at first glance, but when you're growing free cash flow at a high rate, when your return on invested capital is very high, and when you have a lot of competitive advantages, oftentimes that's something that can be justified. I added Microsoft to my portfolio in 22 when it was trading at about $220 per share, and I started buying it on the way up. But as it got higher, I quit buying, but for the first time in a while, I actually added a share to my portfolio. So there you go. Those were the top 10 most bought dividend stocks by super investors in the most recent quarter. Again, if you want to see the full list of the top 50, you can get the list for free at the link in the description. And like always, if you'd like to be able to download any of my automated spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.